Hello and welcome to the first of our group accounting basics sessions. Make sure that you've downloaded the Excel workbook from the link below because we're going to be working through that and the notes that you see in front of you. In this session, we're going to introduce some concepts and we're going to prepare our first statement of financial position. So concepts then. The first one is, what is a group? A group is when a parent company controls a subsidiary. How do they control a subsidiary? Generally, they'll have bought 50% plus of the shares, but the standard actually says when they have decision-making power. Now that could come from a majority on the board, it could come from various other things, but in this course, we are going to assume that it comes from 50% plus ownership. So parent buys a subsidiary, therefore we need to prepare group accounts. What does that mean? Well, the group is now treated as one single entity. So if you think about it, that means we have three sets of accounts. We have the parent set of accounts, we have the subsidiary set of accounts, and now we have to prepare an additional set of accounts, which is the group accounts. Those are the ones we're going to concentrate on, and there are various rules that we need to follow in order to do that. What if the parent didn't buy 100%? We said that control comes at 50%. What if they bought 70%? Well, the rest of it is called the non-controlling interest. So if the parent doesn't own 100%, the NCI, the non-controlling interest, owns the rest. So what are we going to do? We are going to add together the results of the parent and the subsidiary. And then we're going to include a non-controlling interest to show the bit that we don't own in the equity section of our statement of financial position. And I'm going to show you how to do that as we go through. But before we do anything, we always need to prepare a group structure working. So at the start of any question, you need to understand the group. You need to set up a little working that outlines the acquisition date, the year-end date, the parent percentage, the NCI percentage, and the amount that you paid for the subsidiary. You'll see why we need all those things as we go through. And we'll set this out in a working at the start of a question. And we do that for every single question that we do. What's that going to look like? Well, let's have a look at our workbook. So if you've downloaded the workbook, it looks like this. And this is illustration 1. And we're going to look at illustration 1 here and prepare it in the workbook. So what do we see? So we see that the statement of financial position for Almeria and Murcia here is on the 31st of December X5. We also are told down here that Almeria today on the 31st of December acquired 80% for 400. And you can see that actually up here as well. Investment in Murcia, 400. So this is what it is generally going to look like when we prepare a statement of financial position. They'll give you the parent on the left, the subsidiary on the right, and essentially what we're going to end up doing is adding them both together. However, before we do that, let's just prepare our group structure. So pause the video now, go through and pull out the dates, the percentages and the amount paid and jot them down in your group structure working now. Okay, so hopefully you paused the video and done that. Let's plug them in. So we've got year-end date 31st of December X5. That is also the date that the subsidiary was acquired. And that will simplify things, as we'll see later on. The parent percentage, well, they bought 80%. That means the NCI must be 20%. And the amount paid is 400. Remember, they give you that in the notes usually, but if not, you can pick it up from the statement of financial position. So that's the starting point. We now understand the group. What do we do next? Well, down here, we're told that we need to add together the assets and liabilities. And if we were doing a profit and loss, we'd add together the income and expenses in full. because that is what the group controls. Now, even if you didn't acquire 100%, in this case we bought 80%, we still add across all of the parent and subsidiary items because we control them. The ownership will be shown in equity, and there we'll show the non-controlling interest. So we add across the assets and the liabilities. We don't add across the equity. I'll show you how to deal with that in a second. So pause the video now, find the assets, so that's non-current assets, current assets, and then the liabilities, and plug those in, ready to add them across. Okay, so hopefully you've done this. So I'm going to take the assets here and here, and I'm going to add them across. So I've got 100 and 100 here, and then I've got 40 and 200, 60 and 100, 200 and 200. Then the liabilities, remember, not the equity. I'll show you how to deal with those in a second. We've got non-current liabilities, 200 and 200, and current liabilities, 200 and 100. Okay, so that's us ready with the assets added across. What else do we need? Well, the next thing we need is to replace the parent's investment in the subsidiary. Remember the line where we got the 400? We're going to replace that with goodwill, which we will learn to calculate in later sessions, but they give us in this particular one. So we're going to bring in the goodwill on acquisition. We're going to put it in the same position as that investment in Murthia, and we're told that the goodwill on acquisition was 150. Let's do that one together. So there's already a line in there for goodwill. Let's put that in. That is 150. Okay, next step then. So we've now got the goodwill. Remember I said not to do the equity? Well, that's because we only bring in the parent's share capital for the equity. So we don't add across the parent and the subsidiary for this. We just bring in the parent. The subsidiary's equity will be shared out in the goodwill working, which we'll come to later on. So we don't need to worry about it. So we'll bring in the parent's share capital and the parent's reserves. We would also bring in the parent's share of any post-acquisition reserves, but we don't need to worry about those because there haven't been any. That's because we acquired the subsidiary today. So we'll talk about that. We'll go into these workings in detail. But at this point in time, we're going to bring in the parent's share capital and the parent's retained earnings. We'll find out how to work out the post-acquisition retained earnings later on. Okay, pause the video now and find those two numbers and plug them into our statement of financial position. Okay, so hopefully you've done this. You should have picked up the share capital and the accumulated profit of the parents. So we have the share capital, which was 160, and we have the accumulated profits of 240. This will always be the parent, but we'll do a working for the accumulated profits in future because we'll need to bring in some post-acquisition profit from the subsidiary. We don't have any in this question because we acquired them today. They haven't had time to make any profit. So it's simple. Okay, we've got a final item to bring in. I'm sure you've realized because I mentioned it earlier. It is the non-controlling interest, the NCI. Remember, this is the bit that the parent doesn't own. We show it in equity. We'll see how to calculate it in later sessions. But at this point, what I want you to do is find the NCI amount in the question, plug it into your statement of financial position, and then add it all up. So you'll need to add across the assets and liabilities once you've put in that non-controlling interest, and just make sure that it all works out, and then I'll take you through it with me. Okay, let's complete this together then. So the non-controlling interest here at the bottom is 50. So if I put that in here, that is 50. I can now add across the rest. So these ones that I'd put in earlier. And then I can add it up. So my total assets will be all of these added together. And my total liabilities and equity will be all of these added together. And there we have the balancing figure 1150, and we have prepared our first statement of financial position. So that is the basics. Those are the concepts. We are now going to build on each of those. We'll need to work out how to calculate the goodwill, how to calculate the retained earnings, the non-controlling interest, etc. But all of what we do in the future will be based on what we've seen here. So watch the recap that I'll do of this just to make sure that you're happy with everything we've done, and then move on to the next session.